Hello, Edward Lambert, Effective Demand Research, and this is going to be part 4 in a series of videos on how the Fed rate moved since 1978 to the present time, third quarter 2013. So this is the graph that I've been using, which is the monetary model of effective demand using natural interest rates. And I'll just give a brief rundown of what this graph is showing. On the side here you have interest rate measure, which means it could measure the Fed interest rate, natural interest rates, inflation. So you have an interest rate measure on the side here. And on the bottom you have the utilization of capital and labor multiplied together to get the total factor utilization rate. And that's used as a measure of production and output for real GDP. And up here you have these vertical lines are going to be natural levels of real GDP. And there are different levels for different times because there are shifts. And this is really based on labor share. As labor share declines, these levels shift downward. And then in here you have the nominal Fed rate. I have an equation to determine that. You'll see that normally these dots will move in parallel to that line. It's sort of a natural progression to raise the Fed rate along these lines. And then the nominal rate minus the inflation target will give you this dashed blue line, which is the natural real interest rate. And then you have the Fed funds rate, which is this solid blue line here. Then you have inflation, which is the dashed yellow line. Fed funds rate minus inflation will give you this brown dashed line, which is the current real interest rate. And then this downsloping line here is a line called a long-run aggregate supply natural real rate. But what it means is if this is the natural real GDP level right here, where this line crosses it is going to be where the natural real interest rate is to keep the economy at this level and to keep the economy stable at this level with price stability. So if you wanted to change the natural real level of GDP to here, actually you'd have to raise the real interest rate in order to slow down the economy. And if you wanted to put it here, you'd have to raise the rate, the real interest rate to here in order to slow down the economy to this level of real GDP. So, and these dots here represent the Fed rate at different points in time. So here, like this dot here, would be a Fed rate of 3 to 4% with a total factor utilization rate of around 71%. Okay, so that's the rundown on the graph. Now before I get into going through these dots, I'm going to go ahead and explain why these natural real GDP levels shift. And I'm going to use this graph down here. Now this is a graph that uses an equation, effective labor share times effective labor share minus the total factor utilization rate divided by 1 plus the total factor utilization rate. So this uses as labor share changes throughout the business cycle, this line will change, and also the total factor utilization rate will change through the business cycle, and the effective labor share in relation to it forms this line here. This is actually a very important line, and I'm not going to go deeply into it here because that's not the purpose of this video. But where this trend line for these lines crosses the 0% line here, this crossing point and this crossing point and this crossing point represent the natural real levels of real GDP as in terms of total factor utilization rate. And as you can see, as the economy here after the crisis in 2008, this line comes straight in and is pointing directly towards this level of real GDP, a natural level of real GDP, or this level of the total factor utilization rate. Now, we have to realize that the labor share has gone up and down during that time, but its relationship to the total factor utilization rate has been quite stable and linear along this line. So just wanted to point that out. Now I'm going to come back up here to this point here. I'm going to come back up to this graph here and overlay the graph down below. Okay, so I've overlaid the graph on top of the other one, and you can see where these trend lines come down. They're where these natural real GDP levels cross on the graph below. So like this was the line from 2003 to 2008. You can see that little blip here during that time. So right in these numbers in here like 2005, 2006, 2007. The data respected this new level of real GDP, natural level of real GDP. The data respected this level. Even the Fed rate came in, you can see behind here, the Fed rate respected this level. And even before, when the level was up here, the Fed rate was expecting this level from the 1970s to 2003. The Fed rate was respecting this level, except during the Volcker recession when they moved they made an artificial real GDP level around 75, 74%. And so the story that's going to be going forward here is that it's shifted back down to here. So I'll be talking about that a little later on. Okay, let's go into the data now. Now that we know that there's these different levels of natural real GDP, let's move forward. So let's go back in time here to third quarter 2006. And we can see that the Fed funds rate is right here. This is where the economy was, the Fed rate was in third quarter 2006, this blue dot. And we can see that the current real interest rate was right here, where the dashed blue line and this downsloping natural real rate line cross. So when the current real interest rate is where these lines cross, you have price stabilization, as in terms of real interest rates. And we can see that the Fed rate is just a little bit above where it needs to be, that purple line with a nominal Fed rate. It's a little bit above because the inflation rate is 2.8. Okay, so that's where we were in third quarter 2006. Keep moving. First quarter 2007. So this is pretty much the very same spot. And now we see that the current real interest rate is exactly where it needs to be, right where these lines cross. This is the Fed target. This is the Fed target at this natural real GDP level in terms of capital and labor utilization. This is the Fed's right on target now. Okay, let's go to third quarter 2007. This is right before the recession in the fourth quarter of 2007. And we can see that the Fed rate is right here on line, inflation right on target, and the current real interest rate is right at the price stabilization in terms of the real interest rate. So third quarter 2007, the Fed was in balance. They were on target. Things were looking good. They must have felt confident. But then came the fourth quarter, and things began to turn. The economy started to go south. And in this graph, it's going to go southwest. So let's go to the first quarter 2008. We've dropped down to this pink dot. The blue dots have now gone to this pink dot. And the recession starting. We can see that the Fed is reacting to it by trying to lower the rate, the Fed rate, and the current real interest rate has gone down. Now the natural real interest rate and the current real interest rate, there's a difference where the natural real interest rate is above now the current real interest rate. So the Fed is trying to save the economy. They see a bottom falling out, so they want the economy to pick back up again. But something's going on. They see something going on. And that's the thing, is that the Fed saw what was going on. Many people in the financial sector saw what was going on, but the general population had no idea. For months and months and months afterwards, people would have no idea what was really going on behind the scenes. The Fed was trying to control it, but they weren't telling that there was a big problem. This is the first quarter 2008, and it wasn't really until the third quarter 2008 that people began to really suspect that there was a problem. So that's the deal. So now let's go to the third quarter 2008. We come down to this pink dot, we can see that the utilization of capital and labor has dropped to here, and the Fed rate's now at 2%, and the current real interest rate has actually gone negative, even though in terms here it's expansionary, but not really expansionary. The bottom is dropping out, and the Fed's going to have a really hard time controlling the fall here, the problems that are starting to develop. And let's just keep going on. First quarter 2009, all the way over to here, the Fed has hit the zero lower bound. So if you follow this line down here, the Fed rate would normally hit the zero lower bound at around a 66% total factor utilization rate. And here it dropped below even 64% down to here. So the Fed rate was at the zero lower bound even before the recession hit its down point. Let's go to the third quarter 2009. Right here, that's the depth of the crisis recession. And the current real interest rate has gone negative. The inflation rate's 1.5%. The Fed rate is below inflation, so that means the current real interest rate has gone negative. And there it is, the depth of the crisis. At the zero lower bound, the prescribed Fed rate would be negative at that point. And now the economy has to recover from this point, and that's what I'm going to start talking about now. It's a deep story, there's lots of little intricacies, and I have some warnings to put out there, because as we turn back, as we start coming back, the Fed is still thinking that this is where the economy is going to return to, this red natural real GDP line. But from my data, from my research, it says, no, it's going to be here, where this green line is. And these are the dots trickling back along the zero lower bound, heading back towards here, is where I say that these lines are going to, these dots are going to stop at this green line. The Fed is thinking it's going to go all the way to the red line. So here's the economy out here in the depth of the recession, and it's going to start to have turning back. Now, one thing I'm going to put forth here is that there was a change. We come down here. According to this graph here, as the recession started into 2008, 2009, this line shifted. It used to be here for decades, where those green lines are. Then it shifted below the crisis to this lower line here, basically because labor share was starting to decline substantially. And then after the crisis, labor share really fell a lot. It fell like 5 to 6%. And so this line shifted to a lower natural level of real GDP in terms of capital and labor utilization. So I'm going to come back up here and use this as this line here, this green line, this natural real GDP line, as the new target. Now the Fed's not seeing it this way. They're still seeing that the target's over here at this red line, but I'm going to put it here. So that this downsloping line would say, okay, as we come back to this as we come back to natural real GDP, we're going to look for a stable monetary policy at full employment. And you might be thinking, full employment here at this natural real GDP? That's crazy. Full employment's out here. Well, full employment used to be out here too for many decades. And then we found out in the crisis that full employment actually only reached here. And now we're going to find out that full employment's going to be even less full, down to here. And this is what's confusing, I think this is what's confusing the Fed, is they're still thinking they're heading back to this red line here, but really these yellow dots are going to be heading back to this green line. So I'm going to say here that I'm expecting about a 1.5% natural real interest rate. That's where this downsloping brown line and this upsloping blue line, dash blue line, cross. And this is where the economy will want to be as these yellow dots, as the capital and employment utilization come back to around 73%. This is where they're going to want to be. And just just to put these back on there, this is where I'm coming from on this, is that now this line is sloping down into here, pointing out that this is where the natural real GDP is going to be in terms of labor and capital utilization. Sorry, I don't have these graphs totally in line. Can we do that a little better maybe? But as we can see, the Fed rate recognized and respected this area of this graph for decades. And then as it shifted to here, see this trend line coming down here, as it shifted to here, the Fed rate once again respected that shift. And we can see that now it has shifted to here. And so far, the Fed rate and the labor and capital utilization are respecting the shift. Now the question is going to be, is the economy going to be able to go past this point back to a lower unemployment and a higher capacity utilization? I don't think so. The past data has shown that that's not what happens. All right. Okay, so here we are. Come back here. So this is where the economy, I would say, a conservative view would put the real interest rate around 1.5%. That would put, with an inflation target, we would have a Fed rate of 3 to 4%. And look how close we are to that point. We would have to jump way up here to get the economy back into stabilization, which means, according to this analysis, the Fed is way behind the ball here. They're going to, as capacity utilization and employment, this total factor utilization rate comes close to here and begins to stop, the Fed is going to be way behind the ball. They're going to have a lot of catch up to do because the economy is going to be sitting there wondering, okay, what are you going to do now, Fed? We're not moving. Are you going to lower the interest rate more? Are you going to try and do more QE? And the economy won't move from this point. Labor share will not allow it's the effective demand limit is setting these limits. The effective demand limit set this natural real GDP, this natural real GDP, and is now setting this natural real GDP. And the effective demand limit will not allow real GDP in terms of capital and labor utilization to go beyond this point. And the Fed is going to be in for a big surprise. Now, Larry Summers is saying that the negative real interest rate should be negative. So what he's saying is this. Let me go back and draw that up for you again. All I did there was drop the natural real interest rate. You can see this is where I was saying the natural real interest rate should be, at this level of capacity utilization and employment, at around 73%, and about 1.5% a natural real interest rate, allowing for a 2% inflation target. But what Larry Summers, Paul Krugman, Mark Thoma, Dean Baker, and the list goes on and on and on, what they are saying is, no, we're going to get back to here. We're going to get back to this full employment. We're going to get back to 6%, 5.5%, 5% unemployment. We're going to get back to these points. It's just going to take us a long time to get there. And so, but what they're seeing now is that in order to get back there, we're going to need this negative real interest rate here. That's what the data is telling them. In order to get back there, we're going to need this negative real interest rate. They need the negative real interest rate to really encourage business to push production to that point. But the level is really back here. And this brings up an important question right now about the forward guidance of the Fed. The Fed is showing forward guidance towards this point. And this point may be a total delusion because they don't realize that the shift is here. Now let me go back for a second here to before the 2005 crisis to 2003. In here, you see these blue dots? See how the Fed came down? Inflation was low and they were trying to pick the economy back up. Now the Fed may have been thinking that they were trying to get back to this original green line. And along the way back, they thought, okay, let's bring the Fed rate down real low, and then we'll make it back eventually to this green line. And then along the way, they realized, wait, we're going to cut short here. The economy is not going to get back to where we thought it was. So they had to bring the Fed rate up real fast here. So they were fooled. Now the thing is, the old saying, fool me once, shame on you. Fool me twice, shame on me. Okay, so this one shift was the fool the first time. Now you have this second shift. Now if the Fed does not see this second shift, shame on them. They are missing the key point here. I have the equation, I have the graph to show that there's a shift here. And if the Fed misses it, shame on them. And that's basically what I'm saying here, is that there was a shift and there's been another shift, and they have not understood these shifts. They are still thinking that there was this one shift here and they're trying to get back to this point. And in order to get back there, they are seeing a negative real interest rate that's going to be needed to get us to this point. And I'm saying, no, you just follow up this line to the real natural level of real GDP. There. So you go way back up this line to here, and you're thinking, this is where the economy is supposed to be going. The Fed is confused. The Fed is being fooled. There's been a shift in this natural level, and they are thinking it's still out here, and it's really going to be here, according to this point right here. That's been right spot on for the past, since 1960s. These spots here have been right on as to where the Fed rate is going to be stopping. So you got this forward guidance, and what this forward guidance is saying is that we have this big output gap. So you have this output gap from here to here. It's going to take a lot more employment of labor and a lot more employment of capital to get back here. So you have this big output gap. And my view is no. The effective demand limit is saying there is not that much of an output gap right here. So the forward guidance should be heading towards this point right here. And the Fed is way off track. And people are not waking up to this. And the low inflation that we're seeing may be a result of this confusion of uncertainty, where businesses are saying, it's not looking that good. Our profits are starting to slow down, and we're already only here at this utilization of employment and capital. I just don't see how we're going to get to here. Well, Larry Summers says, well, we're going to have to make the real interest rates negative for a long time. But this low inflation seems to be a result of this uncertainty of saying something's not quite clicking here. Something is not quite right. The Fed is saying one thing, we're seeing one thing in our numbers, and we just don't want to invest. We don't see this incentive like the Fed does, and they're going to keep the rates low, but something is wrong here. So the Fed is making a mistake. They're not really, my view is that the Fed is very confused, very anxious about what is going on. And there may come a time, maybe if they watch this video, the Fed will realize, my God, maybe this is true. Maybe this natural real GDP level really has shifted way down. And it's going to take, we don't have much space left. We don't have much time left between employment's going to only come down to maybe 7%, 6.5%, and that's it. And then the economy is going to stop, and we're going to be stuck there on the zero lower bound. And all this money out there with the quantitative easing, and people are going to be wanting to stabilize the economy, and we're going to be way off track. We're going to know about this within the next year. The Fed could be in big, big, big trouble. That's what I'm seeing. Until they wake up and realize that there has been this shift in the natural real GDP level in terms of capital and labor utilization. I don't know what more I can say about it. Is that it's not looking good with the Fed so far off track. Like I say, fool me once, shame on you. But fool me twice, shame on me. And it looks like the Fed is being fooled big time here. Alrighty, I'm going to call part 4 done. That's the story, and the ending so far has yet to be written, but so far the ending does not look like it's going to be good, because the Fed is not waking up to the fact that this should be their target. Where I'm showing here, this somewhere in here should be their target. whether they want the economy growing at maybe 2%, 1% at this target. That should be about where they should be right now. But thinking this negative real interest rate to get way out there, they're just not computing what's going on yet. And we may see a big change within the next couple of months as the Fed really begins to realize something is strange going on. The only strange thing is there's nothing strange about it. Nothing strange about it. We've simply had a shift back down from labor share. They never talk about labor share. Paul Krugman never talks about labor share. So few people talk about labor share. Dean Baker talks about labor share, but he's not applying it to this drop in effective demand, dropping this effective demand limit down to here. Okay, I could go on and on and on about this, but I won't. I'm going to call it done. That's the story, and it's not looking like it's going to be a good ending. All right, bye. This is done.